Assalamualaikum and hi, my name is Nurin, Humaira Binti Zakaria, and I'm from class BA 232 2D. So for today, I want to talk about financial management and analysis of corporate financial performance, a trend and cooperative study. First, I want to talk about business overview. The introduction. In this slide, I will present the ratio of two companies, which is Tomei Consolidated and Pokong Holding Berhad. I will show the value of ratio for this company in the last 3 years, which is 2019, 2020, and 2021. The ratio value will be compared for both companies to decide a conclusion and state my opinion as a suggestion about which company did a better performance. First company is Tomei Consolidated. Tomei was founded in 1968 as jewellery designer and manufacturer. First retail outlet under the brand name Tomei in Campbell Shopping Complex in Kuala Lumpur in the early 17th and subsequently transformed into an integrated jewellery manufacturer and retailer of gold and jewelleries. Tomei was listed on the main market of Bursa Malaysia. Tomei has 4 different brands name, which is Tomei Goldheart, Tomei Goldheart, Lumiere, and De Beers. It also holds the right to franchise the De Beers brand for retailing in Singapore, Indonesia, Thailand, and Vietnam. Second company is Pokong Holding Berhad. Pokong was established in 1976 with the first outlet in Petaling Jaya. Being listed on Bursa Malaysia since 2004 has driven Pokong to even more success since its inception. In 2011, Pokong earning its position as Malaysia's largest jewellery retail chain store. Pokong jewellery has been created with superior quality and materialist craftsmanship. Pokong has created several in-house brands under its belt, such as Trans, Happy Love, Anggun, and the Art of Auspicious Jewellery. Pokong is also the sole distributor for world-renowned international jewellery brands such as Scoffel Luxury Purse from Germany. First ratio that I will introduce is liquidity ratio. Liquidity ratio decides a company's ability to pay its short-term debt obligation. So I choose a current ratio. Current ratio to measure the ability of a company to pay short-term or one-year obligation. It explains to investor and analysis how a firm might make use of its current asset on its balance sheet to pay down current debt and other obligation. As we can see in the table here, Tomei in 2019, it show 1.8 times in 2020, 2.0 times, and increased 2.25 in 2021. And Pokong in 2019 is 3.48 times, 2020 3.86 times, and increased 4.28 times in 2021. Next, under liquidity ratio, I choose quick ratio. Quick ratio is measure a company ability to meet its short-term obligation with the most liquid asset. As you can see at the table below, the quick ratio for Tomei in 2019 is 0.19 times, in 2020 0.25, and increase in 2021 0.36. For the Pokong, the quick ratio for 2019 is 0.25 times, in 2020 0.32 times, and it is decreased in 2021 0.23 times. Next ratio is activity ratio. Activity ratio used by the employer in order to decide the performance with which the employer is capable of use its different operating belongings that are found in its balance sheet and convert the identical into the income or the cash. I choose average collection period under activity ratio. The average collection period ratio measures the average number of days client take to pay their bills, indicating the effectiveness of the business, credit and collection policy. This ratio also determines if the credit terms are realistic. So in the table, average collection period for Tomei in 2019 is show 15 days, in 2020 21 days, and in 2021 is 23 days. For the Pokong, it takes just 1 day in 2019, in 2020 is 2 days, and 2021 is 1.15 days. Under the activity ratio, I also choose inventory turnover. Inventory turnover measure of time that pass from the day an item are bought by an organization until it is sold. One complete turnover of stock means the organization sold the stock that is bought, less anything lost to harm or shrinkage. In the table, we can see Tomei in 2019 is 1.12 times, in 2020 1.08 times, in 2021 1.47 times. For the Pokong, in 2019 1.38 times, in 2020 1 times, and 2021 is 1.18 times. Next ratio is leverage ratio. Leverage ratio to measure the relative amount of debt a company has accumulated. This ratio compare a company total debt, commitment to its asset or equity. Under the leverage ratio, I choose debt ratio. Debt ratio is determined as total debt divided by total asset, and it compares asset to debt. A high ratio shows that debt is used to fund the majority of asset purchases. On the other hand, indicate that a company is running with very little capital. In the table show, for debt ratio for Tomei in 2019, 51.93%, in 2020, 47.99%, and 2021 is 47.31%. And for the Pokong, in 2019, 28.72%, in 2020, it showed 28.14%, and in 2021 is decreased by 25.50%. Under the leverage ratio, there are time interest earn ratio. Time interest earn ratio measure a company's ability to pay its liability based on how much money is bringing in. The ratio indicates whether a company will be able to invest in growth after paying its debts. In the table below, Tomei showed that 1.83 times in 2019, 4.44 times in 2020, and 5.32 times in 2021. For the Pokong, 9.15 times in 2019, 4.42 times in 2020, and 6.64 times in 2021. Next is profitable ratio. Profitable ratio is class of economic metrics which are used to evaluate a business ability to generate profit relative to its revenue, running cost, balance sheet asset, or shareholder equity. Under the profitable ratio, there are gross profit margin. The gross profit margin tells you what your business made after paying for the direct cost of doing business, which can include labor, material, and other direct production costs. In the table below, it shows for Tomei is 25.24% in 2019, 25.14% in 2020, and 2021 it show 18.77%. For the Pokong, it show 20.87% for 2019, 26.54% for 2020, and 21.87% for 2021. Next is return on asset. The return on asset ratio, often called the return on total asset, is a profitability ratio that measures the net income produced by total asset during a period by comparing net income to the average total asset. In other words, the return on asset ratio, or ROA, measures how efficiently a company can manage its asset to produce profit during a period. In the box, for Tomei, return on asset is 2.05 in 2019, 6.51% in 2020, and 6.41% in 2021. For the Pokong, there is 2.21% for 2019, 3.07% for 2020, and 4.45% in 2021. Next, I will discuss about cross-sectional analysis. A cross-sectional analysis compares a firm to its industry peers and is used by investor analysis and portfolio manager. For the current ratio in the last year, it showed Tomei is 2.25 times and Pokong is 4.28 times. The current ratio in latest year of both company shows that Pokong has a solid liquid ratio value better than Tomei in 2021. This determines that Pokong company ability to pay off its current obligation is higher than Tomei. For the quick ratio, for the last year, Tomei was 0.36 times and Pokong was 0.23 times. The quick ratio showed that Tomei has a better value than Pokong in the year 2021. Even though Tomei has the higher ratio, but the ratio is shown is less than 1, which is company may not be able to fully pay off its current liability in short terms for the both company. Average collection period shown in the last year for Tomei is 22 23 days and Pokong is 1.15 days. In this ratio, Pokong has the shorter average collection period, which is just 1.15 day to collecting the debt better than Tomei. In general, a shorter average collection period is preferred to a higher one. That means Pokong has better average collection period because it just take 1.15 days and Tomei take a longer time, which is 23 days. For inventory turnover ratio for the last year, Tomei show 1.47 times. Meanwhile, Pokong show 1.18 times. Inventory turnover ratio show Tomei have higher result than Pokong, which is Tomei 1.47 times and Pokong is 1.18 times. This show that Tomei company sells the product faster and the demand for the product is getting higher. Meanwhile, Pokong is indicate to poor sales and the demand of the product not that high. The debt ratio for the last year show Tomei 47.31% and Pokong show 25.50%. Comparison of the debt ratio between these two companies show Tomei have a higher percentage with 47.31%. This means the high ratio indicate that a company may be at risk of default on its loans if interest rate suddenly rise. Meanwhile, Pokong have lowest percentage with just 25.50%. That means the lower percentage of the ratio, the lower the overall debt. Next is time interest earned. For the last year, for Tomei is show 5.32 times and for the Pokong is 6.64 times. Pokong slightly higher compared to Tomei, which are 6.64 times, while Tomei is 4.32 times. This means Pokong have indicate financially healthy and they can still invest in their operation after paying off their debt. The higher ratio will be less risk involved in investing in the company. For the gross profit margin, for Tomei is show 18.77% and Pokong show 21.87%. The result show Pokong has higher percentage compared to Tomei with the rate 21.87%. The higher of the percentage is better to indicate a higher contribution margin and show the company has more cash available to cover other expenses. Tomei has the lowest rate with only 18.77%, not much different from Pokong. Next is return on asset. For the last year, Tomei show 6.41% and for Pokong is show 4.454%. The result show Tomei has the higher ratio with the percentage of 6.41% compared to Pokong. This show that the company managed to be graded higher level of profit with given level of sale. For the recommendation, based on the observation of these two companies, I found that Tomei Consolidated have the lowest liquidity ratio. They can improve the liquidity by looking at the debt, controlling receivable and payable, and looking for the long-term finance to improve liquidity ratio. Next, the activity ratio show Pokong Holding Berhad is lower rate than Tomei Consolidated. The company can improve the activity ratio by focus on inventory turnover rate, by lower the price of product and improve how they advertising to attract people and focus on higher sale. Next is beside that, Tomei Consolidated situation is risky than Pokong in the leverage ratio. It shows Tomei Consolidated is risk because of the borrower that cannot pay back its debt obligation is at considerable risk of entering bankrupt. They can improve by reduce the cost of product and make the increase of on sale. For profitability ratio, for both companies show that in the gross profit margin, Pokong is higher compared to Tomei, but in the return in asset, Tomei was higher than Pokong. In this case, both companies must take step forward to improve profitability ratio by making new customer and practice to increase current customer average sales. For the conclusion, we can say financial ratio analysis is very important because we will know how our business is doing every year. Financial ratio also offer entrepreneur a way to evaluate their company's performance and compare it with other similar business in their industry. We also can know liquidity ratio is measuring a company ability to pay debt obligation and its margin of safety through the calculation of metric including the current ratio, quick ratio, and net working capital. Next, we also know activity ratio is a type of financial metric that indicate how efficiently a company to generate revenue and cash. For the leverage ratio is used to determine the relative level of debt load that the business has incurred. This ratio compare the total debt obligation to either the asset or equity of a business. And lastly, for profitability ratio, we can say is a type financial instrument use a measure a company ability to earn over time based on its income, operating expenses, balance sheet asset or capital, using data from specific daily hours. So that's all from me. Thank you.